To have with us today Michael Keane. Michael is Deputy Director at the Fiscal Affairs Department of the International Monetary Fund. Welcome, Michael. Today we would like to discuss with you the fight against tax evasion and the international experience in this regard. A few questions for you. I will start straight with the questions. First question is, how important is tax evasion around the world? And what do we know about to address the issue worldwide?
Well, thanks so much, Lorenzo, and thanks very much for asking me to join you remotely today. On evasion, I guess the first thing to say is, of course, if we knew exactly how large tax evasion was, then it would be much easier to control than it is. So we're always reliant on estimates of various kinds, and those show quite wide variation across countries. One of the most careful studies, for example, have been done for the United States a few years ago, but very detailed, very painstaking. And that concluded, for example, in the US, that evasion accounted for about maybe 16% of the personal income tax base. So that's quite a big amount, even in the US. Of course, it varies across countries. In other countries, you may see a lower figure. Sometimes that's to do with how these things are defined. But of course, in many countries, we'd expect it to be even higher than the US. And even if we think about the value-added tax within Europe, and we look at what's called the compliance gap, the gap between what should be collected according to the law, what actually is collected, that varies from very low numbers, from 3–5% in some countries, up to 30%. So in many countries, it's clear that tax evasion is a big deal, clearly simply in terms of revenue. And that means, for example, that we could raise the same revenue with lower tax rates if we could address evasion, less distorting, more efficient tax systems. But I think also beyond that, of course, there is this important feature that evasion can undermine the perceived fairness of the tax system. So if people think that their competing business is getting away with evading taxes, that erodes their own trust in the tax system, may incline them more towards various forms of evasion and avoidance themselves. So we think addressing evasion is important for both in kind of narrow economic terms of revenue and efficiency, but also in terms of trust and faith in the wider tax system, and therefore I think more generally in the state itself. What do we know about the drivers, you ask, of evasion? Well, as you know, we economists would tend to think of evasion as like a gamble. That basically you decide, well, I'll try and evade. It's like a gamble. If I succeed in evading, I'll get a payoff in not paying a certain amount of tax. On the other hand, that there's some probability that I will get caught, and if caught, that there'll be some kind of punishment in addition to paying the tax. So at a first pass, we would tend to think of the things that drive evasion as being, well, what is the probability that you'll get caught if you do evade, and what are the punishments if you then get caught, and tilting the balance in taxpayers' minds in that way. As well as, of course, of trying to find devices to make evasion more difficult as a kind of technical matter, and I'm sure we'll talk more about some of those. So on our first pass, I think those are the kind of levers we would think of. Let's reduce opportunities for evasion. Let's make it more likely evasion will be detected. Let's think about the penalties when evasion is detected. Of course, I think beyond that, we have to think of people as rather more complicated than these kind of gamblers, gambling evaders. Evasion, I think, also depends, and there's quite a lot of evidence for this, depends on the extent that people trust the government, the extent to which they think their money is going to be well spent. So there are these broader aspects of interaction, perceptions of the state that we think can have quite powerful implications for the extent to which people voluntarily pay taxes.
This is very interesting. Thank you so much. There is a lot of discussion also more broadly related to the international aspect of tax evasion. So, for example, related to the taxation of multinationals. And there's been a lot of work on this. Where do things now stand in terms of both actions that have been taken and possible future measures related to this specific aspect?
I think first I would say that I think that the primary problem with multinationals that recent initiatives have tried to address has been rather more on the avoidance side than the evasion side. So rather more evasion being illegal and avoidance being legal. Of course, there's a big grey area between what's legal and what's not. But when we think about multinationals, in terms of recent initiatives, we're largely thinking about avoidance. That is, things companies can do that are within, that at least they would argue, sometimes, as I say, there's a grey area, are within the law. And as you say, there's been a lot of interest in avoidance by multinationals over the last few years, in civil society more generally, I think largely driven by this idea, the perception that many multinationals pay surprisingly low amounts of tax. And that has given rise to some pretty impressive and unprecedented in many ways international policy initiatives. It really began, I think, back in 2013, which was the start of something called the Base Erosion and Profit Shifting Project, BEPS, which is a G20 OECD project. What that really is kind of a firefighting exercise. It's not really trying to change the broad structure of the international tax system, but it's tried to address some very specific ways in which multinationals have been able to game the system. Things like, for example, exploiting treaty arrangements that countries have between them, finding ways of navigating tax treaties in ways that generate some tax advantages that were perhaps not intended when those provisions in the tax treaties were included. Other things like the ability to deduct interest. So that the BEPS project, which is now in the implementation phase, was addressed very much, I think, at maintaining the broad structure of the current system, but addressing very specific rooms for maneuver that companies enjoyed. Things are now, interestingly, I think, and importantly, are actually changing. I think now the discussion is moving much more onto the fundamentals of the international tax system. And just to say a little bit more about where that's coming from, if we think about the current debate on international taxation and multinationals, it's largely been driven by the kind of household name digital heavy companies, the Googles, the Facebooks, so on of the world, and the idea that these companies, they're very reliant on intangible assets rather than factories, so on and so forth, and intangibles for tax purposes can be very hard to value. They can be very easy to move around between jurisdictions to seek tax advantage. And also this idea that these companies can do a lot of business in a country without actually having much of a physical presence there. So Google and Facebook, obviously, we're talking about interacting online. So there has been this sense that, that somehow these digital companies pose particular problems for the international tax system. I think our view at the fund is that now really everything is digital to some degree, and that really trying to ring fence solutions for digital companies is really risks covering up what are more fundamental issues in the international tax system. And those are to do with, without wanting to get too technical, things like the principle of arm's length pricing. So the system is based on the idea that when we look at transactions within a multinational and try and allocate profits that the multinational earns across jurisdictions, we value the transactions within the jurisdiction at prices that independent parties would reach, at what are called arm's length prices. Now, you can imagine that really gets very difficult when you're talking about intangible assets and becomes essentially, and in other contexts too, becomes very difficult to do. So there's a certain amount of dissatisfaction, I think it's fair to say, with the arm's length principle. And I think the key point I'm trying to make is that the BEPS project really took the arm's length principle and some other basic norms as given. Now those basic norms are to a large degree up for discussion. So there are now proposals that are being discussed at the OECD that really envisage quite different ways of sharing out profits, which might include, noticeably, some allocation of profits to countries in which there's not necessarily a factory or a physical presence or something like that, but there are people who are using the product, who are using it, and to some degree, contributing to the value of the product. So this is the argument that says, well, when we, for example, use a search engine, we may get that service for free, but we're actually contributing to the business model of the company providing the search engine because we're providing information about ourselves that is commercially valuable. We're providing information about what we're interested in, our habits, all these kind of things. So there is a movement towards giving some taxing rights to countries, what are called the market jurisdictions, where some degree of selling or use is going on. But that's, I guess, quite a long-winded way of saying that there are now some quite fundamental changes to the international tax system being discussed. Really, after very little fundamental change for decades, we're now looking at quite big changes. This is all kind of very much current issue, still for discussion. The OECD is due to produce proposals for the G20 next year, 2020 at some time, and I think we're all interested to see how that turns out. And I think the only point we would add from our end is that it's clearly important that whatever changes the world may go for, understanding the impact, the economic impact of that, who gets the money, what does it mean for investment, these kind of issues requires quite a lot of attention, and I think probably more attention than it's yet had.
Thank you. Still, Michael, differences in tax codes across countries can create opportunity for tax avoidance. Maybe tax evasion, but avoidance. How do you think, how costly are these for public revenue and for, let's say, allocative efficiency? So how important would be to have an harmonization, especially, for example, in a monetary union like the European, the EMU, for example? How important is current harmonization?
It's an interesting question. Again, it's not terribly easy to put numbers on the extent of revenue loss that countries suffer as a result of tax avoidance by multinationals. But I guess there's now been a number of studies. They might put the revenue losses, say, for OECD countries, maybe in the order of perhaps 0.4 to 1% of GDP, a little bit less than 1% of GDP. So that's kind of, we can argue about whether that's a big number or a small number, but it's certainly a noticeable number. Importantly for us is that our own initial studies and subsequent studies have confirmed that these numbers are actually larger relative to GDP for the lower income countries. Of course, the avoidance is a bigger dollar issue for advanced countries, for advanced economies. But relative to GDP, it's a bigger number for low-income countries, which is why certainly the fund, we're always very anxious to make sure that the discussion reflects the interest of the lower-income countries. When you come to trying to estimate numbers country by country, what the revenue loss is for each country, then you're on even shakier ground. We had a paper earlier this year, 2019, that has a little table that brings together estimates, say, for the G7 countries. If you talk about the US, you might be talking about 15 to 25% of their total corporate tax revenue, the corporate tax revenue principle they should have. For other countries, probably rather less, but I have to confess that for some countries, even the sign is not clear. It's not clear whether some countries are actually winners from this movement from this tax avoidance game. That is, that they have more essentially paper profit coming in to the jurisdiction than they have going out. Sometimes it's not clear whether they're winners in that sense or losers. So there's a lot of uncertainty around about the importance of the issues. I think, again, we also have to think, well, what are the alternative revenue sources? And again, I think this is one reason why we focus particularly on developing economies, because in some sense, other economies, more advanced economies, do have other fairly well-developed tax instruments they could use to supplement or any shortfall of corporate tax revenue. That's less clear in low-income countries. In low-income countries, the VAT is usually under pressure. Personal income tax is under development. Tariffs, we really want to try and reduce tariff revenue rather than increase it. So it's certainly a significant, I would say, issue in revenue terms. But again, I think we have to think about the fairness aspects of it. Clearly, people become concerned when, say, a large multinational that's producing in competition with smaller companies that are kind of operating on the kind of more retail level on the high street. People get very concerned, naturally enough, when distortions arise from the lower tax that some of the multinationals may be able to pay relative to purely domestic companies. So it's more than just a revenue issue again. But nonetheless, I think we would say the revenue is sizable, but not kind of catastrophic for at least for the advanced economies.
Thank you. But is the international tax competition still a relevant issue? So are countries still, trying to reduce or to have favorable tax treatments just to attract, investment or companies. Is a very relevant issue across the world nowadays, or is less so?
Yes, a good question. I think it is certainly a relevant issue. We saw the US, perhaps most notably, in the Tax Cut and Jobs Act in late 2017, had a very large reduction in the corporate statutory rate of corporate tax. It put the US kind of back in the middle of the OECD pack, but it was nonetheless clearly a very marked reduction in the statutory rate of tax. And just in the last few days, we've seen a large reduction in the statutory rate in India. So I think tax competition is alive and well. And in fact, you could even argue that, going back to the BEPS project, that if we make tax avoidance harder, if we make it harder for companies to find ways to make the tax system to some degree irrelevant, then that may actually make it more likely that countries will adopt their own tax system to make it more attractive. As the tax system becomes more relevant, maybe there is more pressure to actually provide attractive tax regimes for companies. So I think there's no doubt that tax competition remains alive and well. Of course, views do continue to differ as to whether that's a good thing or a bad thing. Some people would argue that actually this tax competition is rather a good thing because it puts pressures on governments to be lean and efficient, essentially as a way of disciplining governments to implement efficient tax systems. Others would say, of course, that, well, if we want to limit the scale of government or ensure efficiency, we should think about fiscal rules, or we should think about looking into the quality of public spending. So it remains, I think, a live issue, whether this is a good thing or a bad thing. I think certainly our view would tend to be that most clearly perhaps for low-income countries, again, that have limited additional alternative sources of revenue, tax competition can, I think, be a particular concern. So I think there's no doubt that, to answer your point, tax competition is really a significant issue, and perhaps is an issue that hasn't received enough attention over the last few years. If you think about, you asked me a moment ago what the kind of revenue cost of tax avoidance was. I mean, some of the numbers that come out of those studies, they are much less, they're much smaller than the numbers you would get from a general reduction worldwide in the statutory rate of corporation tax. So even in revenue terms, you could say that, well, tax competition is a much bigger issue than these avoidance problems that we talked about a moment ago.
Thank you so much. Let's move more to domestic issues of taxation. In many countries, concerns with tax evasion concentrates on VAT, value-added tax, correspondingly on self-employment, personal income tax, or small businesses' personal income tax. What are the best strategies and tools to fight this type of tax evasion?
Well, you're quite right. I think all the kind of studies that I had in mind earlier on that look at the evasion, extent of evasion, what we call the tax gap. Recurrent finding is that really the gap is biggest for precisely the groups you mentioned, really the small businesses and professionals, under both the VAT, sales taxes where there isn't a VAT, and under the personal income tax. So I think you're quite right. That's where the main evasion problems lie. There may also be some issues that I think are beginning to be understood better to do with the high wealth individuals who may have opportunities for evasion across borders. But I think if we focus on the small businesses, and that includes, I think we should maybe stress professionals. This is not just a matter of kind of waiters not declaring their tips. It's also, more importantly, in many countries, professionals not fully declaring their incomes. What can we do about it? Well, there are certainly many devices that countries have tried. We can think, for example, of cases in which there are withholding schemes. So if you can control somebody who's buying from a small business, then you may be able to get them to withhold some tax on behalf of the small business that you can't reach more directly yourself. There are other devices people use include, as you know, electronic invoices as a way of trying to establish a record that can be tracked down in terms of purchases and sales. There are uses of electronic cash registers. preferably made tamper-proof, because of course there's a pretty creative world of criminals out there who can invent clever software to try and defeat a number of these devices. There are lottery schemes countries have used where to encourage retailers to issue invoices. There's some kind of way of turning an invoice into a lottery receipt. And there are what we call nudges, which is something that's come out of the behavioral economics literature more recently, which is the idea that let's send various messages to taxpayers. Let's send them various prompts. Let's send them a reminder that you haven't filed your tax return. 80% of the people in your street have filed their tax return. What's wrong with you? Or here, without your money, we can't repair the road at the end of your street, or whatever it is. These kind of nudges. So there's a lot of kind of devices countries have used. Several of these are now being quite closely studied, and I think in some cases the evidence seems to be quite mixed, or at least experience is different in different countries. I think that's true, for example, of the nudges idea. Some cases that seems to work, in others not. In other cases, some of these devices have, in the studies that have been undertaken so far, they do have statistically significant effects. Electronic invoices, for example, seem to have a statistically significant effect. But whether these are big effects or not, again, one can I think argue about. Similarly with lotteries. And I think also all these schemes, you have to be a little bit careful of unintended side effects. The example I have in mind there is that in both the US and Ecuador, there have been interventions that gave the tax authorities better information on a small business's sales. So you knew that the small business knew that tax authorities knew more about their sales. And as a result, they did indeed report more sales. So that's the good thing. But at the same time, they also reported more deductible costs, which were not being monitored in the same way. So at the end of the day, nothing much really happened. So the kind of law of unintended consequence applies here as in the rest of life, sadly. But I think bringing that together, that I think we take away from here is that while some of these instruments can be positive, what's really needed is to understand and target the particular type of behavior that's at issue. And this comes back, I think, to these gap studies that I mentioned right at the start, where the important thing is really not just the overall size of the gap, the 15% number I mentioned for the US, but exactly where does that come from? Is that coming from professionals, from farm operators, whatever it is? Figure out what is the group, what exactly is it that they are doing that we can try to control, and then design a kind of a multifaceted approach to address that. And for example, when the number of countries, UK, Slovakia, had large problems with refund fraud under the VAT, and that required a whole range of responses, and which succeeded, I think, in not eliminating the problem, but bringing it under, certainly reducing its magnitude. And that involved a whole range of things. It involved some policy changes, so changes in the tax treatment of certain imported goods, what's called introducing reverse charge monitoring, reverse charging. It involves some legal changes to make people within a VAT chain essentially jointly liable for any fraud that was going on. And it involves some administrative changes in terms of targeting resources. For example, having tighter checks on registration to make sure somebody wasn't just registering in order to disappear quickly after they claimed a refund. So I think that's an example where we would say that these instruments can be helpful, but there's really no magic bullet. At the end of the day, one needs a kind of a multifaceted, targeted approach, probably spanning a range of interventions. And at the end of the day, there's not much of an alternative to the hard work of audit and enforcement. So you can have all kind of electronic invoices you want, but somebody's got to be looking at the information that's contained within them and using it to check up on companies and to enforce action as need be.
Thank you. One last question, Michael. There is widespread belief that technology can help very much in solving this issue of tax evasion, and for example, in tracking transactions more generally. And one of the debate focuses on the use of cash and how this discourage the use of cash, and maybe instead to subsidize or to favor electronic method of payments. What do you think about these issues. This could be a game changer or not?
I think it's certainly a very exciting time in terms of technology. I think some of the kind of instruments I just mentioned are really having an impact. The e-invoicing, tamper-proof electronic cash registers, I think really do have an impact. So, but I think again, at the end of the day, the new technologies clearly offer exciting possibilities. Any conference these days, you have to talk about blockchain. So let me be the person who mentions blockchain. And, you know, I think we do see possibilities there, for example, in relation to customs and so on, and building in functions within the blockchain that essentially the smart contracts that take out tax payments. So there's certainly potential there. And I think, you know, one of the things we issued, we had a book on this, I think, last year. And I think, you know, even further down the chain, down the line, we can think that some of these technologies may even affect the policies that we want to introduce. For example, if you have blockchain with every transaction essentially monitored and in the chain, it's not at all clear why you need a VAT at all, because a VAT, the attraction of the VAT is really to deal with cases where you can't monitor the chain. So there may be some big policy changes ahead. But I think that's all, I think, some way ahead. We would, I think, again, see technology as does have its potential benefits. We should bear in mind too that there are some very tech-savvy people, savvy people the other side of the legal border. There are some very clever schemes out there that exploit technologies, that weave around the kind of red flags and controls that might be built into the technology at the revenue administration's end to try and get around those. So as in all tax matters, I'm sure there's going to be a kind of continuing battle between basically the good guys and the bad guys, I suppose we can say. So I think the fundamental role of the kind of multifaceted approach I mentioned is going to stay for the foreseeable future. In terms of cash, of course, you're quite right. That's been the bane of tax administrators for centuries. And I think clearly has implications for other areas of policy too, money. And I think we do see the logic and merit in, as in many countries these days, limits on the size of transactions that can be conducted in cash. But again, I think that even that illustrates the core point that at the end of the day, there is this hard slog of audit to be done. For example, if you have a limit on the scale of cash transactions, you have to presumably have some way in which to monitor the transactions not being broken up into a bunch of little steps that fall below the threshold. So technology is exciting. We have to be alert to the potentially evil uses of technology. And at the end of the day, I think we're always going to have to come back to the hard slog of audit, enforcement, and collection.
Michael Keane, Deputy Director of the Fiscal Affairs Department. Great experience, great insights. Thank you so much for being with us. And I hope you might join us physically, in person, one of these days. For the time being, we thank you very much.
Thank you, Lorenzo. I look forward to it. Thank you.